Welcome to another episode of Coffee Chat, brought to you by OfferGoblin. The topic today is going to be the beginning of a technical series that we're doing, mostly focused on accounting. So we've kind of harped again and again to all of you to get started on technicals early. We're going to help you kind of get launched, and we're going to focus on the accounting topic today, primarily linking the three financial statements. We're going to first kind of go into sort of the more intuition about it and what the different statements mean. And then we'll talk a little bit about those linkages, talk a little bit about delivery, and kind of some of the other things to look out for. So stay tuned. First, as a cold open, before you build a list of 100 banks and before you send 40 cold emails or you memorize a DCF, you need to be able to answer this question out loud very succinctly. If depreciation increases by $10, walk me through the three financial statements. If that question in your mind doesn't just have an immediate kind of walkthrough of how that's going to work, then you're really not going to get very far in investment banking anyway. It's important to kind of know this underlying chemistry as it'll kind of give you the basis of um, how to answer questions and not only that, but just sort of how the world of finance works. And so that's what we're going to get into today. So stay tuned. We're going to start here, as we always do, with the state of recruitment. So I can jump in the beginning and say that a lot of people are now starting to post like starting a new full time job. A lot of people are getting rolling, and it seems that all of the full time people have been started at this point. More and more people are starting to get rolling with college, like as in college students, undergrads, and the incoming MBAs, starting to get those feelers out. But Ryan, what are you seeing out there? What's happening on the street?
Well, I think not recruiting. I think some banks haven't fully onboarded yet, so you're seeing a process. But you have started seeing the onboarding process for full-time analysts at banks. So I know some analysts onboarding they're going through they'll be hitting their midsummer reviews soon, and then full-time analysts and associates, depending on which bank you are, they go through different trainings. So theirs are going to be longer than the summer. They can range anywhere from 2 to 4 weeks. And then some banks will start in August. So you see a wide mix in terms of recruiting right now. I think it's a bit of a lull at the moment for people who are either trying to lateral or recruit for an internship. It's just pretty quiet right now, which will
Yeah,
certainly change once end of August hits. And then, you have this expected merry-go-round when people
yeah.
are, you know, if they didn't get an offer, they need to go find an offer, or they got an offer, they're trying to lateral, or the folks who didn't get an internship are trying to break in. So you'll see an interesting
hmm hmm
scramble in August.
I always felt like, and not just for recruiting, but I always felt like the times when no one else is working is usually the best time to get work done. And that's when you kind of can get ahead. So for me, a lot of the core time when I was doing technicals and just like preparation, like foundational prep,
Right.
was the summer before the season started. And then also just like on the weekends and all these other times, kind of when school was starting and people were kind of focused on like making um, making more social connections or kind of like getting back into the swing of things. That's kind of the time when you can actually find alpha, I think, in prep. So as we'll kind of get into in this episode, like here's kind of the beginning blocks of that. So I'll give my high low buffalo, as we call it. I think the high is kind of getting back into working more on the product, the Offer Goblin product. I did some changes to the onboarding. We've got some kind of exciting things coming in terms of like a dashboard and like a landing dashboard. If you're a longtime user of Offer Goblin, and we had hundreds of users last cycle, we expect thousands of users this cycle. Getting started early, and you'll be able to kind of follow along as we sort of continue to grow that product. So a lot of my highs are around like development and all that stuff. Fable 5, Claude released, Anthropic released Fable 5, a new model. ChatGPT released 5.6. So it's always fun when those things happen and you kind of get something to like sink your teeth into. Um, Probably the lows is just I think I don't know. I think it's like there's these cycles of tiredness. I'm probably at a cycle where it's like I've kind of built up a lot of these things and now it's kind of like reassessing and rebuilding and reconfiguring. Um, the Buffalo is I just came back from a long canoeing trip. It was about 10 days, guiding some folks from Farm Lake in Minnesota, so essentially a border lake, out to Lake Superior. So have had some really cool, like kind of physical, interesting journeys with that. So how about you, Ryan? What's new?
Not much new on my end. I'm just have kids I'm working with one-on-one classes I'm teaching and folks I'm training. I will say, whenever you teach, you get a mixture of kids, some that you really like and other kids that you're just like, I'd say this is probably one takeaway for those of you recruiting and those of you doing coffee chats is impressions matter in terms of how you compose yourself. And I would say make it a habit to always compose yourself properly, regardless of the setting, and or else you never know what opportunities you may or may not have in people's network, especially in today's job market. So, I mean, the good kids are the ones that, for example, who stay diligent, ask good questions, aren't playing with their phones. You'd be
Hmm.
surprised. You figure that basic things, but it had been just teaching lately.
What do you think about the statement that's like, it's something like how you do some things is how you do everything, or something along those lines?
I think the saying is something is like, if you can't do the little things right, how can I expect you to do the big things?
Yeah.
Right. And I think it is reflective, right? And then it's also like, wasn't it someone that said like how you spend your days is how you spend your months, and how you spend your months is how you spend your years or something. Um,
Hmm.
it is I mean, it's very interesting in terms of like that who you I mean, I see myself first and foremost as a teacher and the students I have, and you see a wide range of things, whether like coachability, and I think all of this transfers to banking too, right? It's like some folks when you train them is you know they want to be there, they will ask questions and they're coachable, and then there are other
Hmm.
kids who think they're too good to be there, or there are other kids be like,
Yeah.
I'll figure it out later, or then there are kids who just and I would say a lot of times is sometimes, one thing I think people forget about, and this is relevant to banking too, is that and as well as your interviews, is it's not just necessarily the work at hand, but also the impressions that you build, right? And I think that's probably the most valuable part, when you either go to a good school or you go to like an investment bank with a lot of, successful people who are very, going to do great things is don't forget about the impressions you make, right? Because
Hmm.
like, yeah, you might do well on a certain part, but like people do remember. I think one funny thing I was talking about the other day to my students. I think when I was going through banking, there's a kid who showed up drunk every day for training. But I
How
digress.
did you know that?
Well, she also got canned at the end of training. So, um,
Oh man.
but everyone knew she was hungover every day and party hard. But like
Oh
a
geez.
great attitude and coachability is people remember that, right?
Yeah.
So
Yeah, I agree. I think there's like always the little details kind of matter, right? And I think there's like moments. It's like a day is made up of moments, and like you choosing those moments wisely. The hardest one is the phone. I think for most people, like the phone is just this like this black hole. And I think like when I was in banking, if you see someone on the phone, it's like such a faux pas. Um,
yeah,
because it kind of just it I think it pulls you out of the moment. It puts you in this sort of like fake like, you're scrolling and looking at content, you're kind of dissociating with the reality in front of you. But there's also something to be said about all the little details of like something you create. So like we talk about like for the Offer Goblin product, like we put a lot of thought into every little detail, every kind of little screen, every click, every motion
Mhm,
is as efficient and effective as possible. And the same applies to like building a model or studying for technicals or
mhm,
your resume, and all of these details really matter. And so that's why like for this episode as we get into accounting, it can seem kind of boring, it can seem kind of tedious, but it's like if you don't really get this foundation strong, then you're kind of wasting your time because it's going to be clear that you don't have those details. One of the most valuable mock interviews that I did after like as I was preparing for final rounds was this second year MBA who was like very, I don't know if he was just doing it to try to like get us off our game or something, but he was just very like hostile and kind of rude. And he made a very good point, which was like, I got a question wrong. And it was based on the fact that I didn't truly understand certain line items in the three statements.
mhm.
And he was like, "Dude, if you don't understand that, it's like not even worth it doesn't really matter if you can like answer every other question because like you don't actually understand like the fundamentals of this." So
Yeah.
you could get all the questions right, but get one wrong that reveals such a gap in your prep that it kind of crushes you. So that's why I think like it's really important that you listen carefully to this episode. You go through the Goblin 100 questions and the topic
Mhm.
questions. You get your accounting health on Offer Goblin up to 100 because that matters, right? That's probably the most. I would say that this is the most important topic as far as technicals go, and there's a lot of depth to it. So let's get rolling on talking about that. So the
Mhm.
first thing I want to ask is to you, Ryan, and it can come back to me is give me the three statements in plain English. What are the three statements? Well, actually, even before that, yeah, what are the three statements? Why are they important? How do they show up in the world? Like, what even is that, and why do we care?
Well, this answer might not be that short because there's always a lot of nuance in explaining. So, and I also explain it in different ways depending on if I'm teaching modeling as well. So
Hmm.
let's just start with the income statement, or let's just talk about the three statements, right? You have the income statement, the balance sheet, and the cash flow statement, right? And I'm going to talk about this both from layman terms as well as how we think of it from a finance business term and a modeling term, right? So your
Yeah.
income statement is kind of think of it as that's just understanding how your business works, right? How much revenue you bring in, so how much things you sell, right? And then what do those cost to sell each of those items? And then what are your sort of like your fixed expenses? And then maybe some other expenses that you have that like interest or that you have expenses that are not related to is my mic's not going well. This is got a new
A little
mic.
bit of background sound, but
Let's
manageable.
see.
So
Maybe
the
if
three
I
statements to kind of jump off of what you're saying, like the three statements are something that publicly traded companies publish in regular financial releases. So every 10Q, a 10Q is like their quarterly financial release, or 10K, which is their annual version of that. They have to release these three financial statements. And the three financial statements are kind of designed to give different looks at the company's financial health. Each one has a different kind of angle or dimension of that. And kind of the nice thing about that, or the interesting thing about that, is it kind of gives you a way to compare across companies. Like you can compare the income statement of one company to another company. There is a bit of discretion involved in a lot of the statements. So it's not like perfectly apples to apples, but it does allow you to have at least some basis to compare. So, uh, Ryan, you tell me then more about like you were saying that it's a little different when you're explaining it from a modeling perspective. I think I kind of just explained it from more of like, let's say, the business or communication perspective, or like the purpose of it.
so
But yeah.
so I usually when I even get into sort of like whether the reporting standards or stuff, I want students to really understand what they mean. I think the problem when before we even forget about the 400 questions or technicals in general, I think the problem with accounting or instance is like they brute force memorize it without
Mhm.
understanding the structure and why you need each of the statements. So
Yeah.
I always try to translate them into more layman terms. So like the income statement, let's just say, you have, right, whether it's running a lemonade stand or business, right? You start with
Mhm.
revenue line items are how much you're selling your lemonade for. And then cost of goods sold is, well, how much do the ingredients cost? And then maybe SG&A is, and then like includes marketing, how much you pay for the posters, or how much that table that you need to set up that costs you, or maybe you're paying your brother, and then some various things that may or may not be critical. Like let's say someone destroyed your table, you have to go buy a new table. Well, that's an expense, right?
Mhm.
Um, and so the income statement is a great way to sort of understand just a quick snapshot of how your business from an operations, how's it doing and how much money you're generating. Now, keyword here is
Mhm.
I'm saying money, not cash, right?
Right.
And then I usually, for the most part, people understand the income statement, right?
Mhm.
I think when you get to balance sheet and cash flow statement, that's where people fundamentally for example, balance sheet, they think of it, oh, it's just a snapshot in time of everything the company has, and as well as kind of who it owes money to and who owns it. Whereas I like to also think of it as your balance sheet is not only from a business standpoint, is think of it as your income statement in terms of here's how my business is run. Think of your balance sheet as what are the resources I need to
Mhm.
run my business and how do I fund my business, right? And so that you can actually think through to connect it as opposed to people will say, okay, last line item, net income and income statement, that's like first line item and cash flow statement. And then they end up memorizing all this. But then when you interview someone and you tweak
Mhm.
it, they fall apart because they never really understood the statements in the beginning.
Mhm.
So, yes, your balance sheet gives you like the snapshot, but more importantly, is think of it as on the assets, short term, long term assets, short term
Yeah.
assets, operating working capital, things that you need to run your company on a daily basis. For example, your inventory or you have prepaid expenses, et cetera, right? So your balance sheet is dependent on your income statement, right? Then we get to sort of the cash flow statement where I talk about this is that it's important to understand it, I think, from a modeling perspective as well, is that when you get to the cash flow statement, people just say, oh, it just tells me cash. But then a lot of the whole technical questions is nobody really understands why, like from a more deeper perspective of why you need the cash flow statement. They just say, oh, because it tells you cash and cash is king and that's the most important statement. But
Mhm.
then when you walk through all the technical questions, for example, depreciation, et cetera, or for example, they will memorize it, but then let's say we get into
Right.
something more advanced, like let's talk about
Yeah.
accounts receivable or let's talk about cash flow from
Yeah.
operations. They don't fully understand how it's quite
Yeah.
linked. And so I will then dive into more like counterexample is like, yes, your cash flow statements tell your cash, but why do you fundamentally need it? Right. And also
Right.
why is it something that is derived as opposed to just like reported, right? Your income statement, your balance sheet are reported, right? Your cash
Mhm.
flow statements derived. And then, part of it is having them understand how is it derived. And then that will help them have a better intuitive understanding of answering those technical questions. So the cash flow thing, one of the things I tell folks is that your income statement, it tells you money, but it doesn't tell you cash. And the easiest example we use is like, think accounts receivable, right?
Mhm.
Somebody pays you, buys, let's just say, orders 1,000 cookies from you, but
Yeah.
they might not pay you right away for it, right?
Right.
And so that's revenue, but that's not cash. So you have to adjust for that. Or like,
Mhm.
and generally, I mean, depreciation expense, I talk about that as a non-cash expense, but then you we talk about it in a way that you have to understand is like, okay, in your net income, you took out all your expenses, right? And you assumed
Mhm.
it was like, but it's not cash, right? That expense that got down to net income is not cash until you kind of have to add into it. And then people, this is where I think people struggle, where they will just remember depreciation is a non-cash expense, but they don't understand why. So,
Mhm.
and this is where you will see people really struggles through. So, like, then, people talk through what is actually depreciation, wear and tear on a
Yeah.
factory, like, or you buy a car,
Mhm.
it loses its value every year. But does
Right.
money actually flow out of your pocket? No. All right. Um, so, so yeah, I highly encourage that. And we'll go through the technicals, Mike and I, on the nuances and how to be better understanding of, because with interviews today's is IB is just so competitive. If you're memorizing and you're strictly only reading the guides and you just memorize, there's like 50 different ways that you could get weeded out. And so,
Yeah. So here is the simplest way of explaining the three financial statements and the order with which you should do it in an interview. So, income statement, cash flow statement, balance sheet. The income statement is a snapshot of profitability or performance of a business in a period of time. There is things in there which aren't necessarily cash expenses, meaning they could be things that you purchased earlier, they could be things that you're going to get paid for later, but you look at all of them in a period of time to determine the profitability of business operations at that moment. It goes from revenue, so the total money that's coming in, to net income, which is a representation of profit. Net income is then going to go into the cash flow statement. The purpose of the cash flow statement is in order to show the inflow and outflow of actual cash. So, as we just talked about in the income statement, you have these things where money comes in late, cash for something comes in later, or you already had spent that cash before. So, the first thing you're going to do is kind of make those types of adjustments. You're going to add back things or subtract things based on what cash was actually spent. That's broken out into three sections. That's the cash from operations, the cash from investing, and the cash from financing. And at the end of that, you have the net change in cash. That takes you over to the balance sheet. So the balance sheet is a snapshot at a point in time of what assets, liabilities, and shareholder equities that a business has. And those are the three sections of it. So now that we have that net cash, that's going to go into the assets section. That's like an add or subtract to the cash section of the asset. There's other assets that a business has, which depreciate over time. For example, there's liabilities as well. So, like debts and other things, we're going to represent kind of like mark those changes. And, as we mentioned, this is a snapshot. So, this is kind of based on changes that have been made. And then the shareholder equity section, which is a pretty interesting and I would say sort of strange section and probably the most difficult section to understand, that represents essentially the value to the ownership of the business. And to tie that all together, you have the net income changing the shareholder equity, or the retained earnings, which is the last item in the shareholder equity section of the balance sheet. So that's really like the very quick overview of how the three financial statements link and then sort of what they're used for. Now, I think Ryan's kind of getting into sort of some of the modeling philosophy, some of the technical detail, which is really important, right? And if we start on like just first the income statement, we know that the income statement starts with revenue and that it ends in net income. So, Ryan, if you can talk a little bit more about some of the main sections of that. And there's also sort of these like main stages of it too. The way that I think of it is like you land on operating income at one point, and then you land on pre-tax income, and then you land on net income at the end. And so how do you kind of like think about that, like the sections of that? What's the intuition for how that's organized, and what are some ways that people can better remember how that's set up?
so one thing I also want to make clear is net income. Here's a nuance: is when people say net income, they generally mean net income to common shareholders. Now, if we want to get to a technicality, is technically that net income at the very bottom is not quite yet net income to common shareholders. It's net income to all equity holders. And so you
Mhm.
could get an area where you might have situations like preferred equity, and this is where preferred dividends come in. But going to the income statement, where I like to think of it is you can think of at the very top is where does money come in, right? From your business perspective, right? Your business perspective revenue, you sell stuff, you sell cookies. I'm going to just use a cookie example. And
Mhm.
then you could think of it as who do you have to kind of pay for each of the things, right? So cost of goods sold is the ingredients you pay for each of those cookies, right? Gets down to your gross profit. And gross profit is sort of like the easiest, quick and dirty in terms of like strictly from the stuff I sell, how much money I've made, right?
Mhm.
But then going down every other line, and you're paying off different folks, right? So well, now you get down to SG&A, sales, general, and administrative, things that you pay that are more fixed, that are hard to attribute, things like the CEO salary, et cetera. And then you go further down, that gets you to operating operating profit or operating income or EBIT, depending on how you're putting your layman terms, right? And by the way, just a keynote for you guys out there is EBITDA is not an accounting, it's not a GAAP accounting term.
Mhm.
So you will not see an EBITDA line item necessarily on your income statement. Right? That's something that you create later. We'll talk about why for that.
How do you
So
think about EBIT? What is operating like, what does that actually mean? If I saw a company that had, like, their operating income was, like, going up regularly or going down, let's say, how are we thinking about that? Why would we look at operating income?
you can think of it as it doesn't take into the fact of the capital structure, right? It is strictly focusing on the business itself, right? So everything we
Mhm.
talked about right now is we're just understanding the business. For example, like gross profit, how much money you
Mhm.
make just for selling each additional good. I like to
Mhm.
explain it as sometimes a very simplified version is it's kind of like your variable costs, right? For each additional line item, you make
Mhm.
your marginal profit, right?
Yeah.
And then your operating profit or EBIT, earnings before interest and tax, is how much you make once you factor in more of your fixed costs or the things you can't attribute to what you're
Yeah.
selling. Right? And this
I like to think of
is
that as, like, overhead, like, after gross profit
overhead.
into, like, operating. I kinda think
Yeah.
of that as, like, because the gross profit, it's like, okay, we made cookies. We needed this person to be there to sell it. We needed these ingredients. We needed a car. There's certain things that it's like we needed that to get it to the customer. And then below your gross, right? And into operating, it's like, well, you needed someone to go and like run to the library and promote it. You needed someone to go and like pay your taxes. And you needed like, so
Well,
that
taxes aren't
like,
in the operating.
yeah, I mean more like the
Yeah.
accountant, right? You need like, there's
Uh,
like office people whose job, like, there's sort of that like group that is
it's kind of
supporting the
like fixed
function.
costs, right? It's kind of, as you said,
Yeah.
overhead,
Well,
like fixed, but not quite. That's a simplified.
yeah,
But
they're not
just things you
necessarily
can't
fixed,
necessarily
but
attribute to a specific cookie, right? You're not going to be like
exactly, yeah, which I would
this.
call
Yeah.
overhead, right? My simple way of thinking of that is like
Yeah.
that's the stuff that if you didn't have that, you could still sell cookies, but you probably won't sell as much and you won't be able to sell them at scale. So when you get down to the operating income and really between that gross profit and operating income, I think like a lot of consultants and bankers and PE people, they see a lot of meat there that they're like, oh, we can trim that down. There's probably some efficiency that we can make
Oh, you mean
here.
like said the operating expenses, the fixed part?
Right. Because there's like, okay, if we merge these businesses, we
Yeah.
can merge together the SG&A, which is the what is it?
General and administrative.
Sales and general administrative, right? So that
Yeah.
they might think that we can consolidate those and we can lower gross profit is a little bit harder to change because it actually involves like the core things that are necessary for the business, but there's
Yeah.
probably a little bit of slack in that in between that gross profit and operating income. So that's kind of how I tend to think about that. So, okay, so we got down to operating income. What's next? What do we need to do?
Then you have things that afterwards that may or like interest income, interest expense. Those are just now we're getting into non-business operated related stuff, right? Think of this
Hmm.
as non-core. So you can have your capital structure related. Do you have to pay debt holders, et cetera? Or do you have things that you made money or lost money that's not related to your core business? Did your factory burn down, right? That's like an impairment charge. Did you get your asses sued? Okay, well, that's another charge. Or maybe you made money by selling like your factory at a profit, right? That's not going to be part of your operating expenses, right? So think of things as that are not related to running your business as well as people you have to pay after you get your first batch of cash in, right? Then
Mhm.
after that, you get to pre-tax income, right? All the miscellaneous people you have to pay, and then money you may have earned. I got to be pay the tax man, right? It's like,
Mhm.
and so after taxes, then you get down to net income, and sort of you think of net income is like, I also like to emphasize this, like the income statement to an extent is also like who gets paid first, right? At the very bottom is net income to equity holders, where equity holders are the last ones getting paid, right? And so this is where it also relates to retained earnings. Is everyone's gotten paid off so far. You paid off all your expenses, you paid off all your other investors. Now you get to retain the earnings, right?
Mhm.
As the common shareholder, I'm assuming no preferred equity at this point, right?
Right.
And so now when that flows into your cash flow statement, this is where you have to make adjustments because making money is different from cash because and this is why cash is broken down. If you look at the cash flow statement, it's broken down into three sections, right? Cash flow from operations, cash flow from investing, cash flow from financing. And it's broken that down into three sections specifically because you could get not just from running your business, and you can also not get any cash from running your business. So let's just do some examples for it's easier for people to follow along. Is for example, debt, right? If I borrow money, that's a cash outflow, right? But I
Mhm.
won't see that anywhere in my income statement, right? I
Right.
can see it on my balance sheet, right? If debt went up a year, I know I must have borrowed debt, right? So this is also why, you need the balance sheet, but in your interviews, how they're naturally linked is yes, income statement, cash flow statement, balance sheet, because that's how you see it through on the three
Mhm.
statements. From a logic perspective, you do income statement, balance sheet, cash flow statement. But in interviews, you always say income statement flows into cash flow statement, then flows into balance sheet, and how do they reconcile? So, so I mean, I'm going to pause there. If you have any comments, Mike, on whether or not you want to talk about the cash flow statements. If not, I'm happy to then dive right into those for folks on the
Yeah,
call.
so here's a good trick for interviewing when you talk about the income statement. A lot of times you can kind of fast forward to pre-tax income. So if they talk about really anything that occurs before pre-tax income, you can pretty much just skip ahead and say pre-tax income goes down by 10 and then talk about taxes and then talk about net income. So for example, if they say, let's say expenses goes up by 10, what that ultimately means is that pre-tax income goes down by 10. If revenue goes down by 10, pre-tax income goes down by 10. If like SG&A goes up by 10 as an expense, then pre-tax income goes down by 10. So a lot of times when you're answering questions that relate to the income statement, I like to anchor on pre-tax income because it's just a very easy way to like jump down the balance sheet. You don't really need to drain every single line item of the income statement when you're answering questions related to this because um, they don't really need you to recite all of that. A lot of times they're trying to just see if you understand it. And if they want to ask further questions about the income statement, about your understanding of those line items, they totally can. But you don't really need to kind of go like line by line. Um, let's see. Was there
Yeah,
anything
and one more
else?
tip I would add to
Yeah.
that is yes, always say pre-tax income. Don't say EBT or people say EBIT, right? When they mean EBT, right? Because
Hmm.
phonetically, that's what EBT sounds like, EBIT, right? But it also confuses the interview because then I think you said EBIT, right? So
Right.
in your interviews,
Yeah.
always say pre-tax income. Don't see EBIT because you're just asking for trouble.
Yeah. So that's kind of a confusing that would be a pretty confusing uh way to say things, and you want to be very clear and simple in your language as much as possible. So that kind of I think that gives like a good sense of the income statement. Let's talk now about the cash flow statement, and we've kind of alluded to it a bit already because I think the income statement, to me, the income statement and the cash flow statement have a lot of things in common, even though they're, sort of a different accounting method. They are this sort of like they represent delta, right? They represent changes in things over a given period of time. So as Ryan has mentioned, there's the three sections of it, and as we talked about, like the purpose of that is to represent how much cash is actually flowing in and out of a business. And one of the reasons that companies and analysts and everyone really likes this is because there's a bit of discretion in the income statement. You could represent certain things as revenue in different periods of time. You could represent expenses a little bit in different periods of time. But the cash flow statement, it's really hard to lie on, right? Because the cash flow statement is the sort of cold hard facts of what's coming into your bank account and what's coming out of your bank account. Um, so Ryan, what are some tips about the cash flow statement? What are some things that people should know or maybe tricks of the trade there?
I'd say even before you get started in the cash flow statement, I think the problem is people just brute memorize it, right? They brute memorize the depreciation. They brute
Hmm.
memorize inventory, but not people don't understand it why you need it, right?
Yeah.
So I would tell people is like before you even start prepping those questions, understand why it exists. And there's
Hmm.
sort of like two parts, right? One is ultimately, why are you doing in investment banking, right? It's like,
Hmm.
why do you want to get the job and what's the role? The role is you're evaluating companies, all right? So how's that related to the cash flow statement? Well, valuating companies in general at the end of the day is you're just present valuing the future cash flows, right? You're just trying to understand valuation at its core, intrinsically speaking, is
Hmm.
I'm using cash to buy future cash. So
Hmm.
if I'm buying future cash flows, I need to know how much cash company generates. Okay, so this is why I actually care about the cash flow statement. People will say cash is king, look at cash flow statement, but they don't know what the hell they're talking about. All right.
Hmm.
Now, then okay, say, okay, I understand the cash flow statement's important now for my job, why I need to know accounting and why I do valuation, right? But then, okay, so why doesn't the next thing to understand is why does the income statement lie, right? And this is, I think, the hardest part for people is they don't understand why the income statement doesn't properly reflect cash or a health of a business. And I always like to tell this example. And it's like I'd say, okay, you can have a company that makes a ton of net income, right? But they file bankruptcy tomorrow. Why?
Right.
Because they have no cash. Right?
Hmm.
And the simplest example is, you know, you can also be spending a ton of money while bringing in good business, or you could be bringing in good business and having no cash comes in. And one of the things we talked about, like accounts receivable, is a classic one. Everyone ordered for you, you've delivered the goods. And I think this is also a thing where people need to understand how revenue is recognized, right? Revenue just means a contract was signed and the goods were delivered. Doesn't mean you
Hmm.
received payment, right?
Hmm.
So the cash flow statement is broken into three sections to account for that. The cash flow from operations basically says, let's scrutinize and sanitize that net income or income statement. Did I really get the cash from revenue? Okay. If I didn't, that meant I must have more accounts receivable. What about
Hmm.
things like inventory, right? Did I really spend money on inventory or did I have prior inventory, right? Or did I have certain expenses that, shouldn't be counted as a cash expense? This is where
Hmm.
depreciation and amortization comes in. Or maybe you could just pay everyone in stock, right? That doesn't burn any of your cash, right? Pay anyone in equity. So,
Hmm.
I usually have folks really understand that, and this is your adjustments from operations, right? Make all the adjustments for operation,
Yeah.
and then you have things like cash flow from investing and cash flow from financing, right? And these are things that I could also have changes to my cash that are not related to the day to day quote operations of my business. For example, if I had a bunch of cash, maybe I just went and spent it all and bought factories for kicks and giggles, right? That won't
Hmm.
show up in your income statement. Or maybe I
Hmm.
decide to invest in a bunch of securities. That's also not going to show up in your income statement. Or
Right.
maybe I decided to borrow a bunch of money or share buybacks or pay out dividends, right? That's not reflected in your income statement. So the cash flow statement is needed to to get that better sense of where the cash is coming from and how the business is doing so you could properly value it. Um,
Mhm.
and I'm gonna stop there before we jump into other parts, and so you feel free to chime in, Mike, if you have
Yeah. No, I think you bring up a
comments,
lot of
yeah.
good points, and there's other sort of metrics, I would say auxiliary metrics that analysts track with businesses that relate to their ability to collect cash and push off paying out cash. So, like, the core one being, like, the cash conversion cycle, right? And that helps you kinda understand
You might
how
have to walk
much.
through the audience with that in terms of how that's calculated and all
Yeah, we
that,
don't have
'cause
to go in too deep to that, but the idea
uh-huh,
of that is that you're sort of measuring the time that it takes to sell inventory, collect
yeah.
receivables, and pay bills. And so as you look at a business, if they, let's say they have a ton of revenue, but they just have these customers that have, for whatever reason, have some amount of control. Like, let's say they're selling to very large businesses who just like don't pay them for 3 months and they can't do anything about it, or otherwise, right? Those are representations of the company's ability to bring in cash and keep cash. So those are all really important things. They relate to the cash flow statement. Like, a lot of aspects of that kind of get represented, or I would say are those stats are sort of representations of like the health between the income statement and the cash flow statement. And they're also a representation of sort of the economic power of a business, if you think of it. So, for example, a company like Walmart, they have the ability to basically, they have so much scale and so much access to customers that if they were to, let's say, um, purchase inventory from a vendor, and they were going to say, well, we're not going to pay you out for 6 months, the vendor doesn't really have a lot of options in terms of saying like no, don't, because it's such a large platform that they have all the sort of economic power in that dynamic. And similarly, like, they can say to let's say to people that need to buy from them, they can collect that cash immediately because, again, they're this like very large and powerful platform. So you can kind of in some ways assess a business's health or their strength by their ability to make demands on the cash flow statements of other businesses. And there's a bunch of stats that, or there's a bunch of sort of metrics that people use. The cash conversion thing we talked about, the like days inventory outstanding, days sales outstanding, like all sorts of other things about that relationship that a company has with its sort of like uh, with its sort of peers or its like vendors and other entities essentially. And all of that sort of is to represent the health in some respects of the cash flow statement. And as Ryan mentioned, the reason that the cash flow statement is so important, and I think there's a question that's something like, if you're on a desert island with one financial statement, which would it be?
Yeah.
You would pick the cash flow statement. And that's something also, I think that's a Warren Buffett quote. Maybe he would pick the balance sheet actually, though. I'm not positive on that. But the cash flow statement, it kind of cuts through all of that and it gives you this very clear view of like how the business really is doing. What's kind of interesting to me about it is that it's not just operation stuff. Like, there's the cash from operations section, there's also this like cash from financing section. So, like as Ryan mentioned, like if you take on debt, you get a bunch of cash. So that would be represented there. You could also be paying down debt, which would be like an outflow of cash from financing. And then the final section of like cash from investing, and maybe you put them in different order. Actually, I'm not quite sure, but the cash from investing, it's possible that you bought shares in a business and sold it and made money on an investment or a real estate investment. One of the really interesting ones, and I would love to see this this cash flow statement, would be what was Sam Bankman-Fried's company? Uh,
That crypto company
the
that
crypto company.
blew
You
up
remember
was
what it
a
was called?
something FX. Um,
Yeah, yeah.
I know
What is
what
it?
you're
It's something FX. Let's
because
see.
I remember all the
It
commercials. They had some
was
pretty
FTX.
FTX, yeah,
FTX.
FTX.
That doesn't sound right, but that is right. So FTX, what's really fascinating about FTX
Uh,
and their cash flow
it's
statement
like
would be that their
price
cash from
forever.
operational stuff is
Mhm.
whatever. It's probably a little interesting because they have like people making deposits and then they're paying people out. But they were a very prolific investor. They bought early shares in Anthropic, I think SpaceX, like a bunch of companies that blew up.
Basically, they're if they didn't have to liquidate, they would be so rich right now.
Exactly. And they would be rich from their cash from investment section on their cash flow statement. It wouldn't even be something that came from their income statement, which is just a really fascinating story. They unfortunately basically hit a cash crunch and were kind of like, it's sort of like a bank run, as I understand it, where basically everyone thought there was like a bunch of fraud going on, which there was, and it led people to pull cash out really fast. If you looked at the cash flow statement, you'd see all that cash leaving. And those cash from investments didn't come in until much later. And that's kind of one of the things about cash flow is that it's like you could have all of this money, you could have all of this value to your business, but if the cash flow statement just like goes negative like a few turns in a row, you're basically bankrupt and it's basically over. So regardless of what happens, you kind of need a certain amount of cash to cover a period of time in your business, and so that's why the cash flow statement is really seen as the like main character in some sense of the three statements.
Yeah, that
Um
was pretty much the financial crisis, GFC. It was a liquidity issue, right? Everyone had all these MBSs that nobody wanted to buy.
right.
Right.
Yeah.
They
And
had on the
so
asset side on the bank, they had all this, but then like, right,
yeah, it
when people have a run on you, you're kind of screwed.
and there's this really interesting aspect of economics that you can have all these assets and like it's not worth anything until you can like actually sell it, right? So like you could say that like oh well I have all these assets and they're worth all this, but a bank looking at that can still be like, well, okay, but you need 100 million tomorrow. Can you sell all these by tomorrow? No, then it's really not worth as much as that, right? You're going to go into distress proceedings and it's probably going to get sold for less, right? So,
Yeah, so they
um,
usually put that's what we call like a haircut, right?
right.
Like literally, because the body is like a haircut.
So let's get into this final statement now, the balance sheet.
Yeah.
I personally think the balance sheet's the most boring because it's kind of a static, like it's sort of a static view, and it's sort of only just like a moment in time. And the thing that I find the least interesting is that you could have a bunch of cash come in the day before you do reporting. Let's say just like whenever they kind of stop whenever the date is that they take that snapshot, and the next day you could have a bunch of cash come out, and then on your balance sheet, it doesn't really represent perfectly what um what actually what the actual like levels of each asset, liability, shareholder equity was over a period of time. I always thought it'd be interesting if they
Mhm.
took like a median of that instead or did some kind of like range. They give you like the min max of a period, but it is just a single snapshot point. But
Well, I'm
Ryan, what do
gonna
you
push back on that, right? I
Mhm.
actually feel that now I'm assuming you and I might be talking about different balance sheets, but when I think of a balance sheet, think of it as multiple periods, right? In terms
Mhm.
of a balance sheet's never just giving me 1 year. It will give me the last 3 years balance sheets,
Right.
right? And so if you're given the last 3 years of a balance sheet, then it's I often think the balance sheet is very underappreciated in terms of the whole idea of examining a balance sheet is not strictly from that 1 year snapshot, but also the changes over time, the various years.
Mhm.
And then one of the things like you're talking about median and whatever,
Yeah.
right? You actually could calculate that, right? That's just the beginning of the end of last year's time period is the same as my starting amount for this year. Right. So if you want to look at median cash throughout the year or average cash, right, you just usually take the average of last year's and this year's for.
Mhm.
But where it's more valuable and a lot of the metrics, for example, you're talking about cash conversion cycle, that's all derived from the balance sheet.
Mhm.
For example, your days accounts receivable, your inventory days outstanding, your days accounts payable outstanding. Is that why I feel that the balance sheet is underappreciated is because I think most people look at it in the wrong way,
Mhm.
right? You could look at a balance sheet and say, over the years, is you could back into the cash flow statement. You can't back into necessarily. You could kind of, to an extent, back into net income through retained earnings, right? Uh,
Mhm.
but there's like it just requires greater scrutiny. For example, you can calculate are you being better at collecting accounts receivable or are you being able to push back? And it gives a more complete picture too. For example, let's just talk about accounts payable, right? For the most part, most people say having accounts payable outstanding is like a good thing because it shows that you have greater market pricing power, right? That
Mhm.
you can negotiate with your suppliers and don't have to pay them immediately. And Walmart's like the classic Walmart and Costco, right?
Mhm.
But then it's like your balance sheet is also kind of good at also giving you color. Well, not to say you need the income statement is you can also be just like doing business so badly, right? And that you're just not able to pay your accounts payable, right? And
Mhm.
so, but this is where we're going way beyond the scope of what you necessarily need for like a technical interview.
Mhm.
But if you're trying to see that, you would probably look at retained earnings, right? Is retained earnings going down, right?
Yeah.
From your balance sheet. So I would disagree with you, Mike, in terms of I actually find the balance sheet to probably be a gold mine of information, depending on how you look at it.
Mhm.
Um, but I mean, to each their own, right? Cash flow statement is like it makes your life so much easier if you just take a look at it and
Yeah.
take it.
So what I mean by I think maybe it's also because I focus on tech companies, right? And
Mhm.
it's a little more volatile, but in a 3 month period that it takes to go from like one quarterly report to the next, you could have
Ah,
a
you need
pretty
quarterly. You need
wide
more detail.
right, like you could have a pretty wide change in balance sheet. It could end at the same point, right? It could end at $100 assets and then $100 assets for the next quarter, but it could have gone like up to 100,000 and then down, down to zero, and then it ends up at 100, and you kind of miss
uh,
that detail, right? And the reason is because it's a snapshot, and that's just the basis of and that's how any like snapshot type of metric works. Like same thing for like GPS, right? If you are
yeah.
moving through an area and it's taking a snapshot every, let's say, 2 hours, you may have gone a huge range in 2 hours, but you're back to where you started. It doesn't represent sort of that, the
I
physics
think what
term
you're
I don't
saying
think
is
has
like it
worked,
doesn't
but
show seasonality. Is that what
it
you're
just doesn't, well, it doesn't show the motion. It doesn't show, and it can also give like an inaccurate reflection if the business has like volatility in that. But the thing to remember, like for the people listening, is that
yeah,
it is a snapshot, and there's limitations to snapshots, but there's limitations to all three of these ways, and that's why you
yeah,
need all three of them. And so as we go through like each section, so the assets, liabilities, and shareholders' equity, right? The assets are really things where it's essentially representing something that you could either sell or like future, like cash will come to you in the future for having it. So like you could sell like your inventory or like your PP&E, presumably like you paid for that. And it may be not exactly that you could sell it for what it would be represented on the balance sheet, but it's things that are valuable. Accounts
yeah. I
receivable,
think
right?
so. Like,
That
yeah,
has this future value. It's something that like it's worth something essentially. And that's what an
or they
asset
could
is in a very
generate
simple
cash.
way.
Is like they're either cash or they can generate cash.
Right.
Is the way I like to think of it. Yeah.
And the liabilities are sort of the opposite. It's like something that like you're going to need to pay.
Well, now I just realized I'm going to push back goodwill. Technically, you can't sell goodwill.
Well, goodwill is the one sort of like that's sort of a filler concept, but
Yeah, I
in some
know. But
ways you
yeah,
could
you could
sell
get cash.
goodwill.
You just destroy the goodwill, get the impairment charge, reduce your taxes, that increases your cash.
Yeah, I mean, that's sort of like treating it like it's like a tax, like, asset, like a
We're
deferred
just
tax
going
asset,
off the road for fun.
but,
I digress. Go.
even goodwill, if you think about it, the idea would be that if you sold the business, that goodwill would be you would be able to sell the
Well,
business, including that goodwill.
no,
Obviously, the
the
goodwill
goodwill doesn't
itself,
transfer. Yeah.
it's not a tangible asset, but presumably if you sold the business, you would and you got the same price for it, then you are essentially selling that goodwill as a piece of that, right? And it's an intangible
From
asset.
accounting, the goodwill doesn't transfer over.
Well, if you sell the business for the same amount and all
If
the
you sell it,
assets
so like,
remain
but
the same price,
you get new goodwill created, right? You get new goodwill.
yeah. So you
Yeah.
can say like, okay, it regenerates the same goodwill, but the
Yeah.
idea is that
Yeah.
that goodwill is a representation of the sale of the total business. That's the
Yeah.
sale of like you bundle all the assets together and there's still some asset that's in there that's not represented in some like kind of physical asset there that's represented in the price of the business as a whole, and that's what goodwill is. And so it's not like you're selling goodwill as like a like, oh, okay, we're gonna take all of our assets and we're gonna sell goodwill. It's like that's a part of the bundle in some respects.
Yeah.
um so the liability section then is like things that you owe or things that you need to pay out. So obviously, debt is like the most common understood one, that if I buy this business, I need to go and pay off all of the debt. If I, or like accounts payable, I need to go and like pay off all of these people that we owe money to, all these vendors that we owe money to, stuff like that. So, um, liability is similarly like you can kind of think of it as just like the opposite of that. And last thing is the shareholder equity, which, as I mentioned, I think is the sort of hardest one, at least for me to understand, because
Mhm.
it's not like the market cap of the company. It's more like it's sort of what remains after you
You
like
paid off all your liability holders, right? The way I like to
right,
think of it is like your equity part is, and this is where before we start is like equity holders are the guys who keep everything at the bottom of the barrel after after everyone above has been paid off, right? That's probably the
right,
easiest way to just think about it. Is
right,
on your asset side, you have core and non-core things to run your business. And
hmm,
liabilities is just who you owe bloody money to, right?
right,
And then afterwards is you keep the rest. Now we could go into more technical nuances, like if you want to go like what does, you know, additional paid in capital and all that, and then where if you want to
right,
go into like preferred equity or but I think from an easier to understand is common equity is everyone else gets paid off, the rest is your money, right? This is why retained
right,
earnings goes into, right?
hmm,
Net income is the money that was generated by the company the year after it paid off everyone, after it
hmm.
paid off its suppliers, after it paid off its debt holders. And so equity is just the money you kind of keep afterwards.
So that kind of walks you through the three financial statements. And we have a really great article that's how do the three financial statements link together in IB interviews on Offer Goblin. We're going to link that in the description. I spent a lot of time on this topic and really kind of boiled it down to a framework of what you need to know. I think that our framework is probably the most efficient way for you to know and be able to respond to interview questions. We have some sample interview questions that we'll put in the description from Evercore, from Bank of America, Moelis, and some others about different ways of three financial statements. You can click on those and review those answers. I would highly recommend that you do that. And if you have any other questions about the three financial statements, or you have any commentary, or you disagree with us, we'd love to have that discussion with you because I think both of us are very interested in the topic of finance, and feel free to jump in. So, if you're watching this video and you made it to the end, give us a like and subscribe. It really helps us grow the channel. You can find us on any podcasting platform. We recommend that you listen to this sometime in the morning during the recruitment season. And we'll be back next week with a little bit more technicals. So, I'm Michael Neal. This is Ryan Tan, and signing off. Thanks.
Have a good one.